All right, traders. So in this video, we're going to be looking at corrective waves. Specifically, what are the characteristics of corrective waves? In previous videos, I have covered the two phases of the market. The first phase, which is the trending or impulsive phase, and then the second phase, which is the corrective or counter trend phase of the market. So the corrective phase is particularly important. It's also very difficult to get right in terms of being able to identify when a corrective phase is over. I maintain that most traders, even with a very basic level of technical analysis, would be able to distinguish between impulsive and corrective movements on a price chart. The tricky thing is creating rules that allow you to profitably trade the end of corrective waves and ideally to stay in that trade for the meat of the next impulsive or trending phase. So we're going to be looking at characteristics of corrections, and I'm going to be looking at three different kinds of corrections that you will see. So basically, all the corrections that you'll be able to find out there will fall into three broad camps. Right now, it's important that we establish this fundamental understanding of the different kinds of corrective waves we can see, because it then sets the stage for what I call pattern identification, which is where you're looking for a specific trigger that you recognize, that you know is reliable and offers high probability, high risk to reward opportunities on a consistent basis. All right, so we need to first establish, broadly speaking, what corrective waves look like in order for us to pinpoint corrective patterns that we know very, very well and that we know yield good results over time. Okay, so the first line diagram that we're going to look at, and we're going to be looking at a few line diagrams before we jump into actual price action. So the first line diagram that we're going to be looking at is this one right here. And there aren't any trend lines, there aren't any channels. This is simply going to be a line diagram that shows us what corrective waves tend to look like. There are two kinds of broad corrective waves, and then we're going to subdivide one of those kinds into two different types. All right, so there are two kinds of corrective waves. There are deep retracements and there are shallow retracements. So a deep retracement would be something like this, where we see a fairly sharp correction, or it can be slightly less sharp, but the point is that it retraces a significant percentage of the prior impulsive wave. If we're using Fibonacci retracement levels, then we're looking at 38.2%, 50%, 61.8%, and even beyond. Remember, the only rule of a corrective wave is that it cannot retrace more than 100% of an impulsive wave. So long as we don't retrace more than 100%, we're okay. We're all right. We're in good territory. So a deep retracement is, I would say, anything that goes past 23.6%. So even if we go to 38.2% and beyond, we're starting to look at deeper retracements. The second kind of correction will be more of a sideways kind of corrective wave. All right, so now we're talking about time corrections. So there are price corrections, which we've just covered, and then there are time corrections. Time-based corrections will typically travel, I would say, between the 23.6% and the 38.2% retracement levels of the last impulse wave. And they're marked not by a sharp or deep correction into the impulse wave, but rather through a lengthy sideways correction. All right, so what we don't do in price, where we don't correct deeply in price, we instead correct in a sideways manner through time. All right, and then there is another subset of sideways corrective waves, which we will look at last, and that is the kind of wave that I recommend you don't trade, at least not until you've developed a very sophisticated understanding of sideways price corrections. All right, so those are the idealized kind of line diagram versions of price corrections, which are your deep and sharp corrections, and your time corrections, which tend to be more sideways. So here we have an example of one is a sharper correction, all right, which is this flag here. And then we have a more sideways correction, which is a triangle, all right? Now, generally speaking, with one exception, all corrective price action can be contained within either parallel lines or converging trend lines. All right, that is a key characteristic of 99% of corrective price action. So we're looking here at price action, corrective price action that is contained between parallel lines. All right, if we start seeing this, where we start breaking out of a parallel channel in a corrective price move, that would start making me consider the possibility that we're dealing with a potential trend reversal where we will see perhaps a 100% plus retracement of the prior impulse wave. So I really would like to see price action be contained in a corrective wave by parallel lines. All right, now this can take many shapes. We could have significantly sharper price action, which will still be contained within parallel lines. Or we could see something that's a little bit more sideways, like what I had earlier. All right, the important point here is that even if we're looking at sideways price action and it is contained by parallel waves, my expectation is that gradually over time, this channel will effectively result in a net retracement of at least 38.2% of this impulsive wave. All right, so that is a key characteristic of corrective price action, contained by parallel lines or by converging trend lines. So you can see here, obviously, this is an idealized example, and we're looking at a 50% retracement. Once a corrective price move that's contained by parallel lines comes to an end, we should expect to see impulsive price action develop. In other words, I want to see the market pick up steam and start accelerating, in this case, to the downside. And that brings me to sideways price action and how these corrective shapes are different from sharper retracements. Now, I'll be honest with you, I much prefer sharper corrective wave structures. I believe, for one, they generally give you better risk reward profiles, and two, they're easier to identify. The tricky thing with sideways price action is that you can very easily prematurely get into a trade and see it go nowhere. And then when you look at your price chart a couple of weeks later, you'll see, oh, wow, the move that I was calling for ended up happening after all. All right. But when you enter early during sideways corrective price action, it can be very frustrating. I'll give you an example. So here, let's pretend that we have the subwaves here and that we have this wave of this triangle contained within parallel lines. All right. And then we break out of this parallel channel right here, and you go short the market. Right. Now notice what happens. The price action falls for maybe a few days, but then we get another sharp bounce. We fall for another few days, we get another little bounce, and then finally we go. But you're going to be pretty frustrated if you see the market, if you entered here and then the market's coming all the way back to your entry, then it drops again. This has happened to all of us. We know what this feels like. The reason this, you experience this frustration is because you just jump the gun a little bit. It's hard to know when sideways price action in terms of a corrective structure is actually going to resolve. All right. So the key thing here, the difference between this and the sharper retracement that we were just looking at, notice here, we retrace 50%, but then the corrective price pattern is not over. In the last example, once we hit that 50% retracement and broke out of the parallel channel, the market picked up steam right away and broke lower. In this example, once we hit that 50% retracement, that's as high as the correction will go, but the corrective wave is not done. So it's going to go sideways for an extended period of time. And obviously this could, we could stretch this out and this could just bounce around for a significant amount of time. We could see something like this, and then we get the big move. So sideways price action is definitely frustrating to deal with as a trader because it really tends to test our patience. But don't worry, we're going to cover some excellent trading strategies that allow us to trade the sideways price action in a highly effective manner. All right. And then last up, we have what I call expanding corrective price action. This is the trickiest corrective price action structure that you could ever work with. Now, thankfully, these examples are fairly rare. So it's important to still cover this, not so that you can learn how to trade expanding corrective price action, but that so that you can learn to avoid it. All right. Knowing what not to trade, I would argue, is just as, if not slightly more important than knowing what to trade. So we have to recognize, although these formations are rare, we have to recognize them on the price charts when they are in fact taking shape, so that we can avoid being lured into their traps. So why is this kind of price action a trap? Well, we look like we've made a correction. Again, I'm going to pretend this is contained within parallel lines, which it would be. It almost certainly would be contained by parallel lines. We get that breakdown. We get a nice drop here. This is a profitable trade so far. But if you didn't take profits, once we broke below this low, if you didn't trail your stop loss, for example, you would likely be stopped out, because the next wave is going to look impulsive to the upside. So we had an impulsive move lower, a corrective bounce, what looks like an impulsive move lower, but notice how it doesn't travel very far beyond the previous low. And then we get a sharp reversal. So this looks like an impulsive move to the upside. And then you get trapped again, because now you're looking for long positions. You're thinking, oh, maybe this downtrend is over. We made a new high. We can look for higher. We can wait for a corrective move to end, maybe something like this, and we can buy it. And lo and behold, instead of getting another rally to a new high, we get instead a new low. And then we get a corrective bounce, and then the trend actually resumes. So you can see this is a trap. It'll trap bears here. It'll trap bulls here. It'll trap bears here again. And at this point, it's going to be really tough for most traders to figure out if the trend is up or down. All right. So it's important to stay away. If you're not familiar with these price patterns, it's important to be able to recognize them and then stay away from expanding corrective price action. All right. I would classify this as a subset of sideways price action. So this usually tends to be more sideways in appearance. Usually, all right. I've seen examples where we get very steep retracements and we get action that's very dramatic, like this. I've seen this as well, and that is incredibly frustrating. It's incredibly frustrating to trade something like this. It's better to recognize this and avoid it. All right, unless you're very comfortable trading ranges, stay away from price action that looks like this. There are so many better opportunities that you'd be able to focus on in the market. All right, so we're going to look now at some historic price action in the Aussie, basically going back to March 2020. And I've highlighted with trend lines a variety of corrective waves along the way. And you'll notice strong similarities between them. So here we have more of a price correction where we have a sharper decline. All right, and we're correcting this impulsive wave here. You can see we make a 61.8% retracement. The corrective decline is bounded by not by parallel lines, but by converging trend lines. We can classify this, for you old school chart pattern traders, as a falling wedge, right? And then we get our next impulsive rise here. We rally to new highs, and then we get kind of a sideways price action here. You could call this a triangle, you could call it a falling wedge. I really don't care what you call the chart pattern. The important thing is to understand that it's confined, or contained, I should say, by converging trend lines. Eventually, these two trend lines will meet in the future. All right, this is a key characteristic of tradable corrective price action. Right, we rally to new highs once more. We get another sideways correction, another rally higher. We get another kind of pennant sideways shaped price action. We rally to a new high here beyond this high. And then within a still developing impulsive wave, we get sideways price action. We rally to new highs. We get a sharp correction here, and on it goes. And this is an example of that kind of expanding corrective price action. I wouldn't say it's perfectly expanding. This you could argue that yeah, it's not expanding, but this is not something that I'm in a hurry to trade. When the upper boundary line here is sloping upwards like this, and the lower boundary line is sloping upwards like this tells me that, yeah, this structure could actually be a reversal. We could see a drop in momentum, for example, in a momentum indicator like the RSI. So the RSI indicator could be dropping here, showing a divergence in momentum as price is still making new highs. So this is something that I would personally avoid to trade. I might look for a trade within this structure. So if we're on a 4-hour time frame, perhaps on a 15 or 30-minute time frame, we might spot good trading opportunities. But on a 4-hour time frame, if I'm only using one time frame for my analysis and my trading, then I would be avoiding this price action structure altogether. Now, if I pull up RSI, we can indeed see that momentum has peaked here. So momentum has peaked here, and we actually get that bearish divergence. All right. So all throughout this corrective price action structure, even though price is making new highs, this is not very impulsive. All right. This does not look very impulsive to me. Why? Because we're not clearing these prior highs by a significant margin. You can see here we made a brief new high, and then we had sellers come in for a steep correction. Brief new high, steep correction, and the momentum indicators support that. So I have the RSI here, and I have the awesome oscillator here. These are both momentum indicators, and we can see that they both exhibit bearish divergence. So this is something that I would avoid. And you can see, yes, we make a new high, but that is the final new high so far for what is going to end up being a significant amount of time. So we make a new high here in August 2020, and then it isn't until November 2020 that the market rallies to a new high. So there's quite some time, several weeks, few months, where the market is actually correcting this entire advance from the lows of March 2020. All right, so it's very important to take note of momentum. I'm jumping ahead a little bit. Momentum is something we're going to cover in another video in the future. Very important part of trend identification and essentially understanding when a trend is maturing and about to end. So I would argue, even if you wrote this up for a little bit, yes, you had a nice trade, but if you overstayed your welcome, you could have ended up with either an unprofitable trade or a fairly steep loss. Especially if you got stopped out all the way down here. Would most traders sit through this kind of reversal if they went long here? I don't know, but obviously the potential is there for people to hang on and hope that the market's going to turn around, right? Especially if you see this little lift. So anyway, here we get an impulsive bearish movement to the downside, a bearish correction contained by parallel lines, and then a strong bearish impulsive move down. We get another corrective structure, a final impulsive move down, double bottom, and then the market starts rallying to new highs. And you can see, just using the trend lines, I've outlined more corrective price structures, which could be traded. All right, and that brings us, I'm just going to fast forward here to present time. This is a larger bearish corrective structure, which is so far propelling the market to fresh lows below the low on April 1st, 2021. All right, so we're still looking for the market to find support. All right, we've broken back below what I think is a pretty important price handle, around 74 cents. Yeah, around 74 cents in the Aussie. All right, so this currency pair could have a little bit lower to go. That I guess analyzing the Aussie would be a separate video. I want to stay on topic here and really just focus on corrective price action. So the important thing to note here is that all these corrective price action structures, they're contained, the ones that I've highlighted here, the ones that I would consider to be tradable corrective structures, all have price action contained either by parallel lines or converging trend lines. How we trade these structures is also going to be a topic of discussion for another day. All right, but let me reassure you right now, trading a corrective structure or coming up with the rules to trade corrective structures is not all that difficult. So that concludes the video for today, everybody. Hope this was valuable. Hope it was educational content. If you have any questions, please feel free to let me know.